Hi, everyone. Thank you for joining us today as you're coming in the webinar room. We're going to go ahead and do some legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, we are thrilled to bring you today's educational presentation. Let me go ahead and get this up here so I have to redo just a second. My controls weren't working for a second there. Now they are. Technology. Well, attendees are muted, but we do encourage you to ask questions using the chat box. The presenter will answer those queries during or after the webinar today as appropriate. If you have a question that you've asked and we don't have a chance to get to it, go ahead and leave your phone number as well. We'll make sure someone reaches out to you after today's event to address your question. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. So I'd love to introduce you to our guest today at today's webinar. I'm going to start really quickly with our moderators. Chase Tusshouse and Blair Tusshouse are here. They are partners with Tusshouse Wealth Management. Chase, prior to becoming a financial advisor, worked in the manufacturing industry as an engineer for L3 Harris and SpaceX. Chase graduated from the University of San Diego with degrees in industrial and systems engineering. He is a member of the University of San Diego Alumni Board, the co-chair of USD Shirley Marcos School of Engineering and Computer Science Alumni Council, and a member of the Oceanside Theater Company Board of Directors. He and his wife spend their free time mentoring local youth. And a little bit about Blair. Blair has been a member of the Tusshouse Wealth Management team since 2015. He has a Series 65 securities license and an Arizona insurance license. He attended Brigham Young University, where he was a member of the football team. He later transferred and finished his degree in business and history interdisciplinary studies at Arizona State. Thereafter, he received a master's degree in international security from the University of Arizona, where he was also part of the 2014 Fiesta Bowl football team. From 2016 to 17, he attended the University of Nebraska to pursue additional higher education while assisting as a coach on the football team as well. Blair is an active member of his church ministry and enjoys coaching football and volunteering in his community. So Blair and Chase, why don't you go ahead and say hello so we can see your face and know who our moderators are.
Yeah, thank you, Marche. Appreciate it. Very excited, especially today, having Graham here. We love kind of the idea that we'll be sort of teaching about the find out from ETFs and just in ETFs in general, but not come here to hear me talk. So I'll quick send it over to Blair for him to introduce himself.
Yeah, thank you for having us. We're excited to be here today with Graham to discuss more about ETFs and how they can help us with our needs in financial field. So thank you.
Very good. And I'll go ahead and introduce today's presenter. Graham Day is the Vice President of Product and Research at Innovator Capital Management, responsible for product development, capital markets, and research efforts. Prior to joining Innovator, Graham was SVP, Head of Product and Research at a startup ETF issuer and a senior strategist at Invesco PowerShares. He's been quoted on CNBC.com, TheStreet.com, FA Magazine, Fox Business, and Investopedia.com. Graham is a CFA charter holder, a member of the CFA Society of Chicago, and holds a bachelor's degree from Wheaton College. And Graham, we're really glad that you're here today to present. Really excited to learn about what you have to say for us. And let me go ahead if I can get my controls to work. Here we go. I'll go ahead and throw it over to you.
Well, thanks, Marche, and thanks everyone for joining today. Thanks to Blair and Chase also for having Innovator participate on this call with you all. Just a brief history on Innovator. Innovator has a legacy in the ETF space. ETFs have been around since 1993, but we're really only known to track a very plain vanilla benchmark index up until about 2002, when the two founders of Innovator actually started PowerShares ETFs at that time, and really introduced, revolutionized the way that ETFs can be constructed and utilized by financial advisors, extending the use case, extending the benefits of the ETF wrapper across various strategies. And so here at Innovator, we focus on that next evolution of ETFs, which are called defined outcome ETFs. ETFs that allow you to know your potential outcomes before you invest. ETFs that are forward-looking in nature as opposed to backward-looking in nature. We were founded back in 2017. We've grown now to just under $6 billion in assets under management. And our sole reason for existence is to promote the defined outcome investing through the ETF wrapper. And today what we want to do is we want to give a brief overview of the challenges facing advisors and investors today and why we think these defined outcome ETFs are so valuable. So Marcia, if we can go to the next slide. I mentioned just a minute ago that ETFs have evolved significantly over time. 1993, the first ETF that tracked the S&P 500 was introduced. Fast forward to 2003, an ETF was launched that tracked a dynamic index at PowerShares. And since that time, there's been a massive evolution of ETFs, moving from passive index tracking ETFs to actively managed and encompassing a whole array of asset classes, equities, bonds, commodities, real estate, you name it. The ETF wrapper is extremely dynamic and extends a lot of benefits, not only to advisors, but to end investors. And I mentioned that evolution has come to the point where we offer defined outcome ETFs. Again, ETFs that allow you to know potential outcomes before you invest. And we'll touch on the benefits of the ETF wrapper as it relates to defined outcome ETFs in the coming slides. So if we go to the next slide. So what's the market landscape like today? You know, these are common questions that we get from advisors and the questions that they're getting from their clients. And the problem is you have the stock market that is at all-time highs. And not only is it all-time highs, the valuations or how expensive the stock market is, it's also at all-time highs. So usually that means that people might favor bonds, but bonds and interest rates are at all-time lows. Bond yields are at all-time lows. 1% yield on core bonds. That is creating a huge dilemma for investors. Where do I put my money today? Do I put it in the stock market and leave it completely exposed, not only to all the upside potential, but also to all the downside potential? Or do I move it over into what's traditionally been called a safe asset, bonds, and really only offer the upside potential of 1%, 1.5% a year for the next 10 years? It's a dilemma that advisors and investors have not had to face really in history. And this is why, if we go to the next slide, this is why Innovator has brought defined outcome ETFs to market. These ETFs launched back in 2018 have been more readily adopted than many ETFs in this space. We brought the first product and have now launched a series of products in the space and are approaching over $5 billion in assets under management. So why are these ETFs being so readily adopted? We're going to talk about how exactly these ETFs work in just another slide or two. But if we move along, we just highlighted some of the challenges that investors are facing in the market today. Do I buy bonds at all-time, bond yields at all-time lows? Do I buy the stock market at all-time highs? It's really creating a dilemma. What do I do? And Marcia, if we can go to the next slide. We highlighted the challenges. What do investors want though? What are their goals? Because I think oftentimes people look at the S&P 500 and think that that's the goal, when in reality it's not. In fact, most investors, if you think about all the investable assets in the US today, 76% of those are in the hands of pre-retirees and retirees. These investors are no longer looking to take on full market risk. They have made their money. They don't want to make their money twice. They are more interested in preserving capital than leaving it completely exposed in the market. But they also want to grow that wealth. They don't want to simply sit on the sidelines and have inflation eat away at their purchasing power. And traditionally, they could just sit in a fixed income fund and make 5 or 6% a year and be okay. But now with inflation at 4 or 5% a year and bonds yielding 1%, bonds are no longer that safe option. And because of that, these investors that want to grow and preserve their capital, they're looking for yields, they're looking for returns above what bonds are offering today. This is why we think that the defined outcome ETFs are going to be so valuable for investors over the next few decades. So if we can go to the next slide, let's start jumping into why not just invest in equities. Well, as many people know, if you think back to 2008, the S&P 500 lost 37% of its value. And although that seems like it was an anomaly, it doesn't happen very often. But losses in the equity markets do happen, and they are relatively frequent. And so if you're someone who is thinking about retirement in the next few years, or maybe you've just entered retirement, you're in what's called the retirement risk zone, where losses experienced at this time can have a very damaging impact to the long-term trajectory of your portfolio. And preserving that capital is of the utmost importance when you're in this retirement risk zone. But if you look at equity markets, most equity market corrections are between 0 and 15%, but 1 in 10 negative equity markets are 30% or higher. So imagine you just retired and the equity markets fall 30%. That could have catastrophic impact on your portfolio. You may have to go back to work. That is why investors are saying, I don't know if I can take the risk of just putting my money in equities. If we go to the next slide, we can see some of those significant drawdowns that we've experienced over time. Moving the
Just
next
a minute,
slide.
I'm having a little bit of technical issues. Let me
No
see
problem.
if I can just shut this down and start it again. Here we go.
Well, I think, and as Marche is pulling up this slide, what it's going to show is that some of these losses can be 40, 50, 60%. And that's something that, again, when you look at that and you think about, can I take that risk? Can I just put my retirement portfolio in equities? The answer is likely no. But you don't need to put your entire retirement in equities. That's not, you're not trying to keep pace with the equity market getting 10% a year. Most investors are just looking to grow 5-6% a year, but also have that focus on capital preservation. But because of the situation in equities, because we're at all-time highs, and what if equities drop 30% in the next year? Again, we mentioned, if we go to the next slide, that the traditional solution has been, well, why don't we just put you into fixed income? Where fixed income, you could get 4 or 5% yields just a decade ago and live maybe comfortably off of bonds. But as you can see here in this slide, the yields, the income that you are getting from bonds is drastically changed. If you go back to 1976, you could have sat in a bond fund and clipped a 9% coupon every single year. Fast forward to today, and the yields on these core bonds are 1.3%. Inflation today, I think, clocked in recently at 5% year over year. That means if you're sitting in bonds, you are locking in a loss, a guaranteed loss every single year now. And one of the other problems with bonds is that people forget that as interest rates rise, bond prices go down. And that sensitivity of that relationship actually is inversely related to this graph, meaning as interest rates fall, the rate risk of your bonds is going up, which means that if interest rates start moving higher, your bond prices are going to get hit harder. So today, if you're sitting in a bond fund that's yielding 1.3%, and let's say that interest rates rise just 1%, we're effectively sitting at 0% rates today. 1%, that brings your bond yield to 2.3%. That means you would be losing about 6 to 7% in your bond portfolio. If you think about what happens if we go up 2 or 3%, you could see significant losses in your bond portfolios. And that's something that many investors are just not thinking about. Why? Because they really haven't had to think about that. Bond prices and bond yields have been falling for the last 30, 40 years. If the reverse happens, you will see bond prices going down as interest rates go up. And that asset that many people have long thought to be a safe haven could end up being an area where you experience losses in your portfolio. So equities, bonds, it's a tough spot for both asset classes. This is why we are seeing advisors, investors utilizing the defined outcome ETFs. So if we go to the next slide.
Hey, Graham, we got sorry to interrupt here. We got one question actually kind of came in, and sort of about like maybe more the allocation of, okay, most investors probably own equities and bonds, right? So what portion of that, you talk about like the risk there, right? So like when you look at then the overall portfolio, would someone have a majority of their assets in bonds and really be risking that along with the equity risk? Is that related to, I suppose, age really and risk tolerance? But what would you say to kind of that?
It's a great question. And the other risk is that as you are in retirement or approaching retirement, the traditional kind of response is to reduce your equity allocation and increase your allocation to fixed income. And so we often hear the 60-40 being used as the average investor, 60% in equities, 40% in bonds. And as you get older, sometimes that'll flip. You may have 40% in equities, 60% in bonds, but some are 20% equities, 80% bonds. And because of that, you can think of it in two ways, that over the next 10 years, your 80% is going to yield about 1.3% a year. That's just not a whole lot. So you're really going to have to rely on equities to give you a lot of juice in order to make, if you need 4, 5, 6%. Conversely, you also have the interest rate risk of that bond portfolio, so that if interest rates go up 1 or 2%, now 80% of your portfolio is susceptible to that downside in the short term. And so the traditional 60-40 and moving that to maybe 40-60 or 30-70 is really having to be rethought at this point. And many advisors are saying bonds are no longer worth it. Bonds aren't worth the risk for my clients because of interest rates rising, but also because it's mathematically, they're not going to deliver the returns that they have in the past.
So really now you're seeing the risk really isn't just on the equity side, it's across the whole portfolio. So
it's a whole portfolio. It's a whole portfolio. And it's, again, traditionally people would say, I want lower risk. Okay, we'll put you in some more bonds. They don't have as much upside potential as equities, but they're more of a safe haven investment. But today, there really aren't, especially when you consider that you've got that rate risk, but also that inflation's at 4% and your bonds are giving you 1.3%. You're losing money. If you're sitting in bonds, you're locking in a loss, and that does not seem to be a prudent move at this point.
great, thanks, Graham.
Yeah, no problem. And please continue to ask questions. We want to make this as interactive as possible. So what does this get us to? We talked about the challenges investors are facing. We highlighted the risks in equity and bond markets. We talked about what investors are really looking for. So let's summarize all this. Investors, 76% of the assets in the hands of pre-retirees and retirees in the US, they don't need all of the market upside. That's the first thing. The second thing is they want to preserve their capital. They want to have a known level of protection in place for their portfolio so that they don't have to wake up and wonder, if the market goes down 20%, what is going to happen to my portfolio? And then if we keep going here, they know that there's no such thing as a free lunch, and they're willing to forego all of the upside potential of the market to have in exchange a known level of downside risk mitigation. And that known level of downside risk mitigation is extremely important. Why? Because there are a lot of strategies out there that say that they're risk management, and they base that risk management on historical performance. And I think we've all seen strategies that you pull them up and you think, wow, what great performance this strategy has had. And you look back maybe for a strategy that, how did it perform in 2008 when the stock market fell 37%? And a lot of investors base their allocation decisions on what's happened in the past, hoping that it will deliver again in the future. But that is something that, as we'll see in a few slides, those strategies work until they don't. You cannot fully rely on that. The defined outcome ETFs offer the certainty of risk management on the downside and allow you to know your upside and downside potentials before you invest. So Marcia, if we can jump to the next slide, please. Thank you. So this leads us all to defined outcome ETFs. What are defined outcome ETFs? Again, they offer upside potential to a well-known benchmark like the S&P 500 or NASDAQ 100. And in exchange for an upside performance cap, you can have a known downside buffer that hedges you against market downside losses. This isn't based off of past relationships. This isn't hoping that this buffer would work in the future. This is knowing that over the next 1 year, here's my upside potential. And I also know that I have this downside potential. So let's pack that into, what does that mean from an actual numbers perspective? Moving on to the next slide here.
Hey, Graham, if we could stop for a second. We had a question about slide 14. The question is, this sounds a lot like a structured note. How do defined outcome ETFs compare? How are they different or similar?
Yeah, it's another great question. And when we think about these products, they are very, the payoffs that they offer are similar to what you see in a structured note or even an indexed annuity that an insurance company may offer. But there's some key differences. And all those differences are embedded in the value add of the ETF wrapper. Probably the most important when compared to structured notes, tax efficiency. These ETFs, we do not anticipate any capital gains distributions from these ETFs. ETFs are known to be tax efficient. That tax efficiency has been extended to defined outcome ETFs. That differs from a structured note where you buy it, the note matures, and then you are left with a taxable event, whether you want it or not. These ETFs you can hold for as long as you want. And then whenever you choose to sell, that will be your taxable event and not before. Another benefit, there's no credit risk with these products, meaning the protection that we provide in the portfolio is provided by the ownership of underlying options. That means these ETFs do not have any credit risk. You are not crossing your fingers that this protection is going to be in place, but you have to rely on an institution to deliver that protection. And credit risk, it doesn't matter until it matters. And if we rewind to 2008, Bear Stearns, Lehman, AIG, if you had a product that was issued by that firm and you had bought a product that had some downside protection in place, that product did not deliver because it was being issued by a corporation that is most susceptible to equity or to market downside. And that jeopardizes your ability to get the benefit of a buffered solution. A few other key advantages. These are liquid. They're bought on the exchange. It operationally makes life easier for advisors. They're able to get better execution. The list goes on and on. They're transparent. They're fee-based. I think for a lot of investors, when they hear indexed annuity or even a structured note, commissions, high fees, illiquidity all come to mind. When you put it in the ETF wrapper, all of our fees are fully disclosed. There's no hidden fees. There's no surrender charges. If you need to get in or out, you can at any point in the ETF wrapper. And that's a distinct advantage over an insurance product where you may be locked in for up to 6 years. And if you want to get out, you can get out, but you have to pay a 10% penalty. The ETF just gets rid of those really problems that the other wrappers had and frustrations that advisors and investors have had with those wrappers, and ultimately tries to deliver the payoff of a buffer in the most clean form possible. So Marcia, if we can, let's just dissect. Okay, a buffer ETF. Graham says you get some of the market upside, and you have a known level of downside mitigation embedded into the product. So what does that mean? Well, most of our buffer ETFs are over a 1-year outcome period. What does an outcome period mean? Well, an outcome period simply means that over a 1-year time frame, let's say that you have a buffer of, we've got 3 examples, 9, 15, or 30%. You can't have a free lunch. You cap your upside performance potential at 15%, 10%, and 7%. So that first example on the far left, that's a compliance disclosure. That's if the market goes to 0. That has never happened. Let's focus on a major sell-off environment where the market falls 30% over the 1-year time frame. What happens? Well, if you have a 9% buffer, you'd be buffered against the first 9% of losses, and then be down 21% over the outcome period. If you bought a 15% buffer, you'd be buffered against the first 15% of losses and participate in the next 15% of losses. And if you had a 30% buffer, this is worse a little differently. You take on the first 5% of downside, but then you're buffered from -5 to -35. So if the market's down 30%, you're down 5%. What about on the upside? Let's look at that growth market. If the market's up 7%, which is what most people, if they could get 7% a year from their equity bucket, that would be great, especially given the past performance we've seen in equities. All of these strategies would be up 7%. If the equity markets go up 30%, each of these would hit their performance cap of 15%, 10%, and 7%. And so because, again, where the performance that equities have had over the last 10 years, many are expecting equities to deliver single-digit returns over the next 10 years. So these ETFs could participate in the majority of the market upside, while also ensuring that you have a built-in buffer of 9, 15, or 30% every single year. If we can go to the next slide. How do these ETFs work? I mentioned a 1-year outcome period. How do they move during the outcome period? What can I kind of expect my ride to look like? Well, first, do these ETFs work? The answer is yes. We have had over 70 ETFs complete outcome periods, and each of the ETFs have done exactly what they said they were going to. In this example, we highlight our 15% S&P 500 buffer ETF, which gave a 15% buffer from March 2019 to the end of March 2020. And if you think about that time frame, that was ended with COVID, and we had an enormous amount of market volatility during that time frame. And this is where a lot of those strategies that had worked in the past started to not work, and the downside that they experienced in some cases greater than the market. But if you can see here, there's a couple of things that we want to highlight. First, the light blue line is the performance of the S&P 500 over this 1-year outcome period. And you can see the market kind of started going down, and then it just shot up. It was up almost 20% in February of 2020. Our ETF, PAPR, the 15% buffer ETF, had a cap of 10.6%. So that was their max gain potential over the 1-year outcome period. And you can see it didn't hit that performance cap, even though the market was above, it was up almost 20%. Why is that? Well, because these have time value, and that you have to hold for the entire 1-year outcome period to fully realize the upside potential or the downside buffer. Following February 2020, we all know what happened. The market fell off a cliff. It lost 34% in a matter of weeks. And this ETF did exactly what it was supposed to do. Over the full outcome period, the S&P finished down just under 9%. And this ETF, net of all of our fees, was down 73 basis points, 0.73%. And it did so with half the volatility of the S&P, half the drawdown. The product did exactly what it was supposed to do. And again, that's where we, simplifying risk management. A lot of people try to do that, but this is dependable. And if we go to the next slide, that's what investors want. They want to know that they can rely on that.
Graham, there's a question I want to quick get in. In January 2020, the buffer ETF is approaching the cap. Can you sell that buffer at that given time, or do you have to hold it all the way through the outcome period?
Yeah, it's another good question. The answer is you can sell these ETFs at any time during the outcome period. There are no restrictions. There are no lockups. And it's really one of the benefits of being able to work with an advisor who can monitor these things for you. And that if it's approaching a cap, you can lock in your gain and maybe reset into a new outcome period. We offer a series of these products, which are tools that we produce to equip advisors to help their clients make the most informed investing decisions possible. So let's again get back to the risk management, and do these ETFs deliver? Yes, they deliver, but I want to contrast that to some of the more popular risk management strategies in the ETF space back in 2020. Ideas like low volatility or dividend-based investing. I think a lot of investors hear dividends and think about safety. A switching strategy that tries to time the market to get in and out at the right time. This is the performance of all of 2020. And you can see that even though the market had a significant drawdown, 34%, it finished the year up 16%. Our ETFs did not have that same experience. They experienced significantly less of the drawdown. They finished the year at their performance caps, 7.7%, 6.9% net of fees. But look at the difference in the max drawdowns of these two ETFs versus the S&P 500, as well as contrasting that and comparing it to low volatility, dividends, timing the market, or a defensive equity strategy. Those strategies in many cases had higher max drawdowns in the market. And low volatility, for example, was not low volatility. It was the same volatility as the market. You had no benefit. In 2008, that strategy had delivered. It had mitigated approximately 40% of the market drawdown. In this case, many investors experienced the same, if not more, drawdown. A switching strategy got you out of the market, but didn't get you back in the market in time. So a switching strategy actually lost you money in 2020. Low volatility lost you money in 2020. That's the beauty of defined outcome ETFs, is that you don't have to worry about that, because you know that, look, over a 1-year period, if the market's positive, I'm going to participate in that over the next 1 year up to my performance gap. If the market's down, I know I have a buffer of 9, 15, or 30%. I don't have to worry about the market's recovering. What do I do now? The market's selling off. Is my protection working? That's the benefit of having a forward-looking investment vehicle like the defined outcome ETFs. Marsha, can we jump to the next slide, please? So I mentioned that we have built an array of tools for advisors like Blair and Chase to utilize with their clients. And those exposures, so what do we have with Buffer ETFs? Well, we offer the 9, 15, and 30% buffers on the S&P 500. We also offer 15% buffers on the Russell 2000 or small caps, the NASDAQ 100 technology. A lot of people are concerned that technology has had such a run. Can it sustain that momentum for the next 10 years, or is it more susceptible to drawdowns? Or even international and emerging market investing. US equities have had an amazing run over the last 10 years. Over that same time frame, emerging markets have done nothing. They've actually been sideways, had a lot of volatility, higher drawdowns than the US equities. And so investors are saying, oh, I need to position more towards international markets because of the run that US equities have had. But do I want to have all that volatility in my portfolio? Again, the benefit of having a known buffer in place. And so we offer these. You can see some of the sample tickers below. And Marcia, if you can just move to the next slide. Here's a sample of our October offering. So I say October offering, what do I mean by that? Well, each month we offer a new or rebalanced set of exposures on the S&P 500, which means that BOCT, for example, which has a 9% buffer over a 1-year period, the end of September 2021 to the end of September 2022, you can participate in that and have a defined outcome for that 1-year time frame. Well, what about we're coming up here on the end of October? Well, we offer a November series on the S&P 500, so that if you wanted to participate in the November series, a new outcome period would be starting on November 1st. we have December, we have January, we have all the months on the S&P, and then we offer all the other exposures on a quarterly basis. It sounds like a lot, but in reality, we want to remember the simplicity of this product of buying it and knowing over the next 1 year, here's my upside potential, here's my downside potential. That's a huge value add for clients. And given the size and scope of this lineup, that's one of the reasons why we think it's so valuable to work with advisors so that they can maximize the opportunity set, that if you are approaching a cap, they can sell it, they can lock in the gain, they can rotate you into a new exposure, and they can give you the confidence that this portfolio is being managed.
So Graham, question here. When we talk about cap, are we talking about a 1-in-1 ratio with the indice, or is it more of a participation rate like a annuity would present itself?
Yeah, it's a great question. It's 1-to-1 on the upside. So there's no participation rate. So Marcia, if we can just go back to the previous slide. So we highlighted BOCT. That has a 1-year outcome period. The starting cap is 13.69%. So gross of fees, if the market is up 10%, you're going to be up 10%. If the market's up 13%, you're going to be up 13%. If the market's up 20%, you're going to hit your performance cap and be up 13.7%. So all of these products track 1-for-1 on the market up to that performance cap, and then you can see each of their buffers there on the left-hand side.
Very cool. And I think, this is, I think on the next slide, something about question and answer. So, we have a few questions that come in here, so we might as well just, let's go ahead and jump into some of those here while we're rolling. So one of them, and you kind of touched on it earlier, Graham, was, maybe just reiterate or explain to us again, because I know, that we talk about like buffers and caps and all that, but how are defined outcome ETFs able to use buffer? Like you talk about this 9, I think it's 15 and 30% rate. Like, how does that actually work? How are these defined outcome ETFs able to incorporate that buffer and provide that for their investors?
Yeah. So we accomplish that, or the product accomplishes providing that known buffer by buying 2 options positions. And so these are options on the S&P 500. Now, before people think, wow, that sounds complex, the beauty of these ETFs is that they're incredibly simple. We buy 2 options positions that provide that 9, 15, or 30% buffer, and we don't touch it for the entirety of the outcome period. That's what allows us to ensure that we have that buffer in place. Other strategies will try to tweak those options positions. We do not do that. We leave it fixed. And as we mentioned before, the benefit of owning the options is that you don't have credit risk. You're not banking on an institution like a bank or insurance company to deliver that for you. You have no exposure to Innovator. Those options are yours. If Innovator were to go out of business, you'd be left holding those options positions. And what some people forget too, or don't realize, is that the options market on, say, the S&P 500 is one of the most liquid markets in the entire world. What do I mean by that? I mean that every day in the S&P 500 options world, there are hundreds of billions of dollars traded in that market. There's almost $6 trillion of open interest in the options market. I bring that up because it shows that it is a mature, it's a massive market, and that being able to buy and sell is no problem when you are dealing with a liquidity pool that is that wide and that deep.
Yeah, Graham, to follow up on that, how do these defined outcome ETFs track the index like the S&P during the outcome period? Because I know there was a slide previously it wasn't, the lines didn't overlap, perfectly. So can you touch on that for a sec?
Yeah. So these ETFs, we have ETFs that have a 1-year outcome period. So let's use that as an example. And let's have an example where the cap is 10% and we have a 15% buffer. And let's say in the first 6 months of the 1-year outcome period, let's say the S&P goes up 15%. Well, we have a 10% cap. And so we get the question, well, shouldn't I be up 10%? And the answer is no, not yet. And the reason is because there's still 6 months of time value remaining in those options. You will have participated in a good portion of that gain, but not all of the way to the cap. So, kind of a back of the envelope, estimate would be if the market's up 15, you have a 10% cap. We would expect you to be up maybe 7% or 6% at that time frame. And the way to think about it is that let's say the market just stays flat for the rest of the year. It was at 15, it finishes at 15. Our ETF would go from being up 6% and slowly approach its performance cap of 10%, because you know that at the end of the outcome period, if the S&P is at or above the cap, this ETF is going to have moved and hit that performance cap of 10%. So the lag that you see on the upside and the downside is called the time value lag. But again, what's important to remember is that if you hold it for the entirety of the outcome period, the ETF will fully deliver on the stated upside cap or the stated downside buffer. But Blair, as you pointed out, if someone wanted to roll out at that time, they would have the ability. For some investors who bought a 15% buffer and 6 months in, they're up 6%. For a lot of them, that's all they need for the year. Lock in that gain, roll into something maybe that's a little more defensive, maybe our ultra buffer that has a 30% buffer. Lock in those gains, reset your buffer. There's a lot of things that you can do through the ETF wrapper because of its liquidity that you have never been able to do with the other wrappers that have been available in the past.
Thanks, Graham. We got another one here. It's kind of on the flip side of the coin. So why might someone not want to invest in a defined outcome ETF? And maybe give some, like, in what cases would it be best to go with a different kind of investment? I suppose that might depend on age, time horizon, some risk tolerance there. But so what are your thoughts on that?
We tell investors is that if they want full equity exposure, these are not the right products for them. If they want to ensure that, look, if the market goes up 30%, I want to be up 30%. These products aren't for you. But again, what we find is most investors, or for even a portion of their money, they want something that's a little more predictable, has a more defensive posture to it. So even if they do have that unhedged equity exposure where they're just saying, I'm going to ride it with the market, another portion of their portfolio could be a little more defensive. And so they could use these ETFs as a more defensive posture to the market. But in general, what we tell investors is if you want that full equity exposure, the upside and the downside, then these products aren't necessarily for you. But maybe you have a portion of your portfolio in unhedged exposure, use this as a defensive allocation. Or as we've talked about, we continue to find more and more individuals going to their advisors and saying, I like the safety of bonds, but that safety is kind of in the rear view mirror. I need an alternative. I need something that looks and feels a little bit like bonds, but gives me some more upside potential. And that's one of the reasons why we're seeing investors say, I'm ditching my bond exposure or a portion of my bond exposure. Bonds have historically delivered a negative relationship correlation with the stock market. So you're taking on added equity risk, but you're taking on measured equity risk because you have the known buffers of 9, 15, or 30% in place. That's actually been one of the most common ways that we've seen these ETFs being implemented. If we think about the 60-40 that we talked about, if year to date stocks are up 16%, bonds are down 2%. They've lost 2%. The yield on those bonds had moved from 1.2 to 1.4%. Most investors are saying, I don't know if I want to rebalance back into bonds, because the 60-40 is now almost 65% equities because of how much equities have appreciated, and 35% bonds. Well, usually you rebalance at the end of the year, and we have a lot of investors telling their advisors, or advisors telling us, we don't think it's worth taking that extra equity exposure and putting it back in bonds. The picture in bonds has not gotten any better. In fact, the cracks have been exposed now of potentially what we could see in bonds for the foreseeable future. I'm going to take that excess equity exposure. Rather than leave it unhedged, I can move some of it into my buffer ETFs, again, to have more of a hybrid approach between pure equity exposure and bond exposure.
Yeah, so it sounds like this is really like part of a full strategy, and I think that's the thing that we're really hitting on here, is that it's, if it's addressing a very specific piece to an entire portfolio, that depending on what your goals are and everything, and then I guess, and maybe you can kind of touch on this too, if it sounds like if it's used as a fixed income replacement, well, fixed income, there's a variety of durations there. Could you also then use this as potentially like a cash management strategy?
Yeah, the use cases that we've seen for these buffer ETFs have been, wide reaching. And for some investors who maybe they have clients that have just sat on the sidelines or are in that 80% bonds because they just can't take the risk of jumping into the equity markets, some will use the buffers as a core equity exposure. We have ultra high net worth individuals who, for them, their risky asset is crypto. Their safe asset, or their, let's say, more moderate risk investment, are stocks. And now their safe investment are these buffer ETFs, because they don't need 1% income. They're not living off of that income, and they don't like the upside potential. So, it varies based off of risk tolerance, time horizon, and the individual client situations. And again, why an advisor is so valuable in those situations. But we also have an ETF that provides a 20% buffer every 3 months. Now, that's a lot of buffer over a 3-month time frame, meaning every single 3 months you're going to get a new 20% buffer. The upside cap on that is a lot lower. This quarter, it's 1%. Now, 1% doesn't seem like a lot, but that's 1% over a 3-month time frame. You compare that to what you're getting on money market funds, you're getting nothing on money market funds. Even if you're in short-term debt, you're getting 20, 30, 40 basis points a year on that. We're seeing investors say, yes, I realize the Fed is making me take additional risk to make money. So using that product, which is the ticker on that is BALT, BALT, that I'm going to be able to participate in the equity market up to 1%. But let's say the market falls 15% in the 3-month time frame. That doesn't happen very often. I would be buffered against those losses. We're seeing investors use that as a way, not necessarily to say like this is cash-like, but to get some of that cash off the sideline. That, as we said, with inflation, where it's at now, you're just locking in a loss if you're sitting on the sidelines, if you're sitting in short-term debt, if you're sitting in a money market fund. Your purchasing power is being eaten away. And so here's a way that you can fight back.
Awesome. Thank you, Graham. And I think we're kind of coming up on time here. So just want to thank you for the presentation today. And yeah, I'll pass it off to Marche.
Well, thank you. I appreciate it. It's interesting to know about these things. Thank you so much for being our guest. I know you're not the only company in the Buffer ETF sphere, but it's great to know from someone who does this every day and sees those happening, participating in the market all the time. I know I do have to show some disclaimers here for compliance purposes. And I want to thank the guests that have been here today. Thank you, Graham, Blair, and Chase. And thank you for the organizations that have made this possible. A little bit about for our guests, we'll be sending a replay of this event to your email, so do look for that. And you're welcome to share that with friends and family who will be interested in this information. We'll also be hosting it on our website. So here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Just find out more by going to advicechaser.com, clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we will see you at another webinar soon. Goodbye, everyone.